ES Audio.
From the Evening Standard in London, I'm Rochelle Travers, and this is The Leader. Brace yourselves, it looks like we may already be in recession. Interest rates have gone up again, for the seventh consecutive time in fact, to 2.25%. It's up by half a percentage point and takes borrowing costs to their highest level since 2008, during the global financial crisis. Interest rates have been rising since last December as inflation increased to its worst level in 4 decades.
The Bank of England is raising its interest rate, and other central banks are doing the same, really, to fight inflation, which has roared back over the past 18 months in a way that seemed almost impossible in the years before the pandemic.
A chief market analyst at IG giving his reaction to the news there. This all comes as the Bank of England warns that the UK may already be in recession. But what exactly does this all mean for us? Jonathan Prynn is the Evening Standard's business editor.
So the Bank of England announced today that their main interest rate is going up by half a percentage point from 1.75% to 2.25%. And that in turn will have a knock-on effect on interest rates through the economy, not least in mortgage rates.
Jonathan, put this into context for us. How much of a hike in interest rates is this in the grand scheme of things?
Well, it is significant because obviously to go from 1.75 to 2.25 is a big percentage rise in the cost of borrowing. Previously, until the last time the Bank of England put rates up, which was a couple of months ago, rates had tended to go up by quarter points or even less. So it is quite a significant rise, and it will be adding, typically £90 to the monthly repayment bills of someone on a £300,000 variable rate mortgage. So that mounts up. So yeah, it is significant.
Why exactly is this happening?
Well, the Bank of England has a mandate to keep inflation at a target as close as possible to the target of 2%. And inflation is obviously running way beyond that at the moment, around 10%. So, some 5 times the target rate. So they hope that by increasing the cost of borrowing, that will dampen down economic activity and start to bring inflation back down again.
How do interest rates affect people in their day-to-day lives?
So, probably the most obvious and well-known example is on mortgage rates. So, mortgage rates tend to be linked to the Bank of England's main interest rate. If you're on a variable or tracker rate mortgage, you'll see the impact of that straight away as your interest rate on your mortgage adjusts in line with what the Bank of England has done. Most people now are on fixed rates, so they won't change immediately. But as you come to the end of your fixed rate period and have to remortgage, you'll see that your mortgage rate goes up substantially as you lock into a new fix. But also, there's all sorts of other forms of borrowing, of course, across the economy. So you'll see interest rates on credit cards, bank loans, all those things will go up as well. But equally, for savers, remember there are more savers than borrowers across the economy as a whole. It's good news for them because savings rates on bank accounts and other forms of savings should start going up so that you get more interest for your money.
What could be the knock-on effects of this level of interest rate hike?
Well, the worry is that the higher interest rates go, the more the economy is dampened down because people have less money to spend, and that sort of sets off a cycle that can lead to recession ultimately, with the economy going into reverse. In fact, the bank have said today that may already have happened, and they indicated in their forecast that GDP possibly fell by 0.1% in the third quarter of the year, which would come after a 0.1% fall in the second quarter of the year. And economists say that when you've had 2 consecutive quarters of negative growth, that amounts to recession. So it's quite likely we're already in recession. And of course, the more expensive borrowing and credit becomes, the more it dampens down the economy.
As you mentioned, the Bank of England says we may already be in recession. When will we know for sure?
We'll know when the Office for National Statistics publishes the GDP figure for September, which will be probably well into October. We will then know if the economy did indeed shrink through the course of the third quarter, which covers June to September. And if it did, we know that the economy was down in the previous quarter, the April to June quarter. So 2 consecutive negative quarters, then that's recession.
Do we have any idea when things might stabilise?
Well, I think the hope is that as we go through the winter and beyond, hopefully energy prices will start to ease. We've got the energy cap coming in, the government's new energy cap coming in on October the 1st, which will take a little bit of the sting out of inflation. So inflation should start falling away gradually next year, and by the end of next year should be well below the levels that we're seeing now, and then eventually get back down to its 2% rate. And if that happens, then the Bank of England might start feeling it can loosen things a bit and start reducing interest rates back down to where they were. Maybe not all the way back down to where they were, but certainly down from where they are now. And then hopefully we can get, the economy can start picking up steam again. But the bank at the moment is forecasting quite a protracted recession, possibly all the way to the end of next year. Maybe not a particularly deep one, but like the one we saw during the global financial crisis, or some of the recessions in the 80s and the 70s and 80s, which were much deeper. But nevertheless, quite a long recession. The question is then, can we recover strongly maybe in 2024 and get the economy really moving again?
Let's go to the ads. Stay there to hear more about why we may already be in recession and what the interest price hike means for you. Whilst you're here, why not give the leader a rate and follow? Welcome back. Jonathan, how are we compared with other countries? Are they going through similar economic issues?
They are. I mean, it's a massive global slowdown which has been caused by a succession of issues related to the pandemic and the problems with the supply chains all over the world, the continuing problems with COVID in China, which more actually do seem to be getting better now. But of course, most crucially of all, the war in Ukraine, which has massively increased the cost of energy around the world. So all economies around the world are struggling to A, contain inflation, B, having to put up interest rates, and C, seeing their economies slow down and in some cases go negative. I think we're not certainly far from unique in that situation, but it looks like we might be in for a longer and deeper recession than some other countries.
Also, there's been some news about the pound against the dollar, hasn't there?
Yeah, the pound has been very weak all this year for a variety of reasons that the markets don't really like the look of the British economy at the moment. So the pound's been falling for quite a while now. In the last few days, it's fallen below sort of 114, 113 to the dollar, which is the lowest rates we've seen since it almost went to parity back in 1985. So most pundits probably expect it to go weaker still, possibly down to 110. The question is, will it keep going down towards parity with the dollar, which we've never had? Never in the history of the British economy has the pound fallen as low as 1-to-1 with the dollar. The closest it got was 105 in 1985, and that record, could be in danger. So very bad for people taking holidays in America. Great for Americans who want to come to London and spend money in London shops. So could be good for the London tourist economy. Also good for the London property market, particularly the sort of central London property market, because a lot of wealthy buyers, not just Americans, but other people in sort of dollar-pegged currency areas, London property is actually very cheap for them on a global comparison. So that should keep interest in prime London property very strong.
And finally, we're getting a mini budget tomorrow. Are we expecting anything in that to help with the current situation?
Liz Truss has made it clear, and Kwasi Kwarteng, the Chancellor, as well, that they want to unleash some really big tax cuts to help kickstart the economy. I think it's almost certain that the increase in national insurance that we saw from Boris Johnson's government a little while ago to pay for improvements in health and social care, those are going to be reversed, almost certainly. Corporation tax looks like it's going to be frozen rather than increased. And stamp duty is a really interesting one, particularly for London. It looks like there's going to be quite a substantial reform of stamp duty. Stamp duty rates were increased quite dramatically, particularly on higher value properties in 2014. And critics of that have said it's been bad for the London property market. So it's looking like a lot of those increases will be reversed, and that again could be good for London property.
And that's it from The Leader. This podcast is back tomorrow at 4 p.m.